Across the United States, a surprising group of businesses is stepping into the spotlight. It's not the Fortune 500 giants with massive global operations. It's not the startups experimenting with cutting-edge ideas. It's the mid-sized companies, the manufacturers, suppliers, logistics firms, and consumer brands that sit between small businesses and major corporations. These mid-sized players are leading a powerful shift in the U.S. economy, a new wave of nearshoring. They're moving production, sourcing, and assembly closer to home, often to Mexico, Canada, or even within U.S. borders. And what's interesting is why. These companies aren't just following trends, they're the ones accelerating them. The story starts with vulnerability. Over the past few years, mid-sized companies felt the pain of global disruptions more intensely than their larger competitors. When ports shut down, when container prices skyrocketed, when overseas factories paused production, big corporations had the reserves, backup suppliers, and leverage to manage the chaos. Mid-sized firms didn't. They often had fewer suppliers, tighter margins, and smaller teams. Every delay hit harder. Every shortage created bigger operational gaps. That experience made one thing painfully clear. They needed supply chains that were closer, more reliable, and easier to control. Nearshoring became the obvious solution. Another reason mid-sized companies are leading the shift is speed. Compared to large corporations, mid-sized firms can adapt faster. They don't have endless layers of management or complicated approval chains. They make decisions quickly, execute faster, and pivot when needed. When the global supply chain started crumbling, mid-sized companies didn't wait for multi-year committees or global restructuring plans. They moved fast to find new partners closer to home. This agility helped them secure capacity, lock in contracts, and establish regional operations before many larger firms even finalized their assessments. Cost is also playing a major role. For mid-sized companies, rising expenses, from shipping to materials to labor, hit especially hard because they lack the deep financial buffers of multinational corporations. Nearshoring helps them reduce long-distance shipping costs, avoid expensive container logistics, and minimize the financial impact of unpredictable lead times. Mexico, in particular, offers competitive labor costs, strong manufacturing infrastructure, and the benefit of proximity. Lower transportation expenses and shorter supply chain timelines give mid-sized firms more predictable margins and more financial stability. Another advantage is communication. When production happens halfway across the world, time zones, language barriers, and long travel distances make collaboration slow and frustrating. Mid-sized companies don't have massive international teams dedicated to managing offshore relationships. Nearshoring solves that problem. Being able to hop on a short flight to Mexico or Canada makes supplier oversight easier. Being in the same or similar time zone improves responsiveness. Faster communication leads to faster problem solving, fewer errors, and higher production quality. Nearshoring also helps mid-sized companies compete with larger brands. For years, big corporations used global production to gain an edge in pricing and scale. But nearshoring levels the playing field. By producing closer to demand centers, mid-sized firms can reduce inventory delays, launch new products faster, and react quickly to market changes. They become more nimble than giants with global operations stretched across continents. Shorter supply chains give mid-sized businesses agility that big companies cannot easily replicate. Quality control is another major factor. Overseas production sometimes comes with inconsistent standards, especially when companies rely on multiple suppliers across different regions. For mid-sized firms that can't afford large quality assurance teams traveling the globe, this created costly problems. Nearshoring brings manufacturing closer, making it easier to enforce standards, oversee operations, and maintain consistent output. Higher quality reduces returns, improves customer satisfaction, and strengthens brand reputation. Risk reduction may be the biggest motivator of all. Mid-sized companies learned that global instability, whether geopolitical tensions, trade restrictions, natural disasters, or health crises, can disrupt production overnight. They don't have the financial cushion to absorb those shocks repeatedly. Nearshoring significantly reduces risk. Shorter supply chains mean fewer vulnerabilities. Regional production means greater control. And partnerships within North America are more stable than relying entirely on distant markets with unpredictable conditions. Another reason mid-sized firms are leading nearshoring is their growing investment in automation. Modern robotics and advanced manufacturing equipment have lowered the cost of producing goods domestically or regionally. A mid-sized company can automate key processes, reduce labor dependence, and bring production back without massive workforce requirements. With automation balancing cost differences, nearshoring becomes far more economically viable. It creates a competitive advantage that doesn't rely on low-cost labor alone. Customer expectations are also reshaping the strategy. Consumers always wanted fast delivery, but now they want stability and reliability. They want products that aren't delayed for months due to overseas shortages. Mid-sized brands that nearshore can promise quicker delivery and fewer stockouts, advantages that translate directly into higher sales. Retail partners also favor companies with stable supply chains. Nearshoring helps mid-sized firms secure shelf space, expand distribution, and strengthen retail relationships. Government incentives are further accelerating the movement. In the U.S., policies supporting domestic and regional manufacturing, including tax incentives, energy credits, and infrastructure investments, are making nearshoring more attractive. Mexico has also become a hotspot thanks to its trade agreements, skilled manufacturing workforce, and ongoing investment in industrial infrastructure. For mid-sized companies with limited capital, these incentives can make the difference between staying offshore or bringing production closer. Another subtle but important factor is sustainability. Shorter supply chains reduce carbon emissions from transportation, improve transparency, and help companies meet environmental targets. Mid-sized firms, which often don't have entire sustainability departments, benefit from the built-in environmental advantages of nearshoring. It's a practical solution that supports customer expectations and regulatory demands at the same time. There's also a cultural shift happening in these companies. Leaders are thinking more about resilience, not just price. They want stability over volatility, predictability over risk, and long-term partnerships over short-term savings. Nearshoring fits this mindset perfectly. It creates supply chains built for speed, control, and durability, rather than low upfront cost. What makes this trend powerful is that mid-sized companies are not just following big corporations, they're paving the way. They are the early adopters, proving that nearshoring works, that it can reduce risk, improve quality, and stabilize operations. Their success is inspiring larger companies to follow, creating a wave that is reshaping North American manufacturing and production. In the end, mid-sized companies are leading the nearshoring movement because they have the most to gain and the most to lose if they don't adapt. They're nimble enough to change quickly, hungry enough to seize opportunity, and experienced enough to understand the value of resilient supply chains. As global uncertainty continues, this shift will only grow stronger, and the companies that invest now will be the ones best positioned for a more competitive, more regional, and more stable future of manufacturing and production.